My name is John Turner. I'm the head of the Global Mining Group at Fasken. Welcome to our webinar, Mine Finance in the Current Environment, part of our mining issues in the current world. Before handing over to our moderator, Sarah Gingrich, for those of you who don't know the firm well, Fasken is a firm of over 750 lawyers and 10 offices in Canada, South Africa, the UK, and China. It basically follows the mining industry globally. And we pride ourselves on being a full service law firm to the mining sector. We've been ranked number one globally in mining law 11 times, including the last 5 years in a row. And in 2020, we were ranked the number one mining law firm in Canada by Best Lawyers in Canada. We're also proudly the new sponsors of the Canadian Olympic Committee, as we have been for the Canadian Paralympic Committee for a number of years. So hope you enjoy the seminars. We've got a great panel for you today. And without further ado, Sarah Gingrich.
Thanks, John. Hi, everyone. It's a pleasure to be here. I practice securities and M&A with a focus on mining out of our Calgary office. This is a second panel in the series of 5 mining webinars. We have 3 more planned. You can access the past 2, one on June 1st and this one if you want to see it again through the link that's at the bottom of your screen. But we also have 3 more coming. We've got one on June 15th, which is International Mining Investment and Developments. June 22nd, Critical Mineral Supply Chains for Clean Technology, a New Economic Opportunity. And then the last one on June 29th, Key ESG Issues. And you can see the link at the bottom of the screen if you want to register for those or see them again. We have an interesting agenda for the next 80 minutes with 5 panels and a question and answer session following. Our first speaker will be Grant McLaughlin from our Toronto office, and he will cover mining and private equity, the current reality. Next, John Torrey will provide an overview of bank financing. We have one change in our panel. Guy Winter will be replacing Brian Graves and will give us a London capital markets update. Sounds like they're open for business. Following Guy, Gesta, Abols, and Darren Reed will discuss material adverse change clauses in light of the global pandemic. And lastly, Krisztián, Tóth, and Brad Freelan will review recent trends in RTO and M&A activity. We will then look forward to your questions. Please submit those through the Q&A chat box, which is located at the bottom of your screen below the video. So let's start with my colleague, Grant McLaughlin. Grant?
Thanks, Sarah. It's a pleasure being here, and it's thank you for attending this sessions. I hope everyone has been enjoying at least the better weather in Canada that we have. It's a little bit of a reprieve from the COVID news we hear on a daily basis. So my name is Grant McLaughlin. I'm the co-head of private equity. I'm based in Toronto. Work a lot with mining, private equity companies, and other industries also. And I thought I would provide this group with a kind of little bit of a market temperature of what the current reality is in the private equity world. And it may not be that surprising that, look, the first quarter for private equity deals globally and outside of just resources was down fairly substantially compared to 2019. Number of deals were approximately 26% down. In the US, not as many resource deals, but their private equity in the first quarter stayed fairly steady. But we're expecting that the second quarter is likely going to see similar, not ton of activity in the private equity sector, but we're optimistic that the second half of 2020 will see more activity. As we're all aware, look, the practical realities of COVID makes doing deals challenging, to say this to the least. PE firms in general, and speaking with our clients, I think have moved from, in the first 60 to 80 days, the first, I call the triage phase, where they spent a lot of time just managing cash flow, managing cash position, managing liquidity and balance sheet issues on their portfolio companies to make sure they can, they've got a number of months to withstand the pressures of COVID and businesses being shut down and people being restricted in movement. I think in North America, we're coming out of the triage stage, and in speaking with our clients, they're in the, I would say, manage phase. That they've triaged, they've looked at their credit facilities, their default provisions, They've done up to date, to the extent that they can, cash flow positions. And on a positive note, based on all the government surplus, government programs, and very other actions they've taken to reduce expenses, reduce headcount, kind of focus on key customers, overall, we've seen companies take dramatic and drastic actions and have fared the first part of the storm fairly well, and have got their companies, at least they've got an idea of what cash they may need the next little bit. So I find that the private equity firms right now are still they're out of the triage stage, but they're in the managed stage of positioning, pivoting, really trying to figure out how their portfolio companies are going to operate coming out of the various business lockdowns. So I see that phase lasting kind of the next couple months, and we're in June now, but I think we will see a little bit more deal activity in the second half of 2020. The reality right now between the US and Canada and various countries, travel restrictions make it very difficult for companies to go meet management, go see projects, and do the kind of physical diligence necessary to make any kind of significant investments. That said, I have spoken with clients that they are already making schedules and looking at opportunities such that when the borders open and when travel restrictions loosen up, that they are looking at some new opportunities, and will be kind of trying to get back to business as usual. So for the next little bit, like I said, I think we will see a still limited deal flow in the space, but I can tell you that lots of firms are eager to get out and look at opportunities, and they are looking at opportunities that are coming across their desk. Speaking with one banker that covers their private equity space, he's received a lot more calls in the last month on people looking to do some kind of transactions. So we're in a little bit of a wait and see mode, but I expect that to there's light at the end of the tunnel, and I expect to see that with activity ramping up a little bit. Credit markets are tight. Sellers are, I think, slowly coming out of the woodwork. They're engaging bankers. Some resource companies are definitely looking at, that have a little bit more critical need for capital, are definitely reaching out and looking to, talk to private equity firms. So I think that's all positive. As everyone knows, there's a ton of dry powder out there in the private equity sector. They say $2.5 trillion. So that money is going to be looking for a home. We will see, again, people looking for deals. Some of the stuff we've seen, we've had clients contacts in the precious metals sector, potential activity of actually taking money off the table because the prices are high. So the precious metal sector and the resource has definitely seen a lot of activity from the M&A, and also seen it from the financing, and it has been really strong. So we definitely see that there's maybe an opportunity for some private equity firms to take money off the table in that sector. In all the kind of industrial metals and other commodities, obviously it's a little bit more, there's still a question mark on where the economies are going worldwide, and pricing is still difficult to determine at this time. We've seen some pipe financings in the resource sector. We think that a private investment of public entities will come up a little bit more, I think, in the next few months. Surprisingly, the capital markets have actually been fairly buoyant for raising funds, and resource companies have been able to access some equity. And a number of companies like Air Canada raised $1.16 billion. So the capital markets have been buoyant. We haven't seen the distressed opportunities quite filter to the surface yet, but people are, like I said, waiting till the second half, once we're out of the kind of first part of the storm, to see that companies who are suffering a little bit may have to go to market. we may see some distressed bridge financings being put in place at that time. From a fundraising perspective, private equity firms have actually still continued to raise funds. A number of our clients have looked at opening up distressed funds to focus on companies that need bridge or distressed financing. The good news is most LPs and most GPs in the industry haven't seen a wave of breaches by LP and not meeting their commitments under the agreements, and that's probably been a function of the equity markets being very buoyant. I mean, it's hard to believe that the Dow and S&P is almost back to levels pre-COVID, so that's kept people having liquidity in their pockets. So the private equity sector or industry overall has been pretty resilient and buoyant here from a fundraising perspective. And from not having any defaults by their LPs. So what we will think we'll see coming up in the second half of this year, so it's June now, heading into September, before September, we believe there's going to be some good activity in the resource sector. There'll be a continued number of alternative financings. We think pipes will be one, but we think royalties, streams, and those will all still be a key part of the financing package for many of these companies. A number of private equity companies are re-upping their investments in the resource sector, and there may be opportunity in some of the industrial commodities that are a little bit down to see some M&A activity if their cash flow and balance sheets are still distressed come September. So that would be what we think is the current reality now and what we're seeing from our clients. Overall, I actually think it's fairly positive in light of what we're going through this pandemic, and I think we will see some activity as we come later in the summer and beginning in the fall. So Sarah, that is my update on private equity.
Many thanks, Grant. We'll now move on to an update on bank financing with John Torrey of our Toronto office. Over to you, John.
Thanks, Sarah. My name is John Torrey. I'm a partner based in Toronto with the Fasken Banking Group. My remarks today focus on bank financing in the current environment, both existing and prospective, and are informed primarily by experience with financial institutions, both domestic and foreign, active in lending to TSX-listed mining companies. So Sarah, thanks for the slide. So existing bank financing. The first thing to really remember, I think, it's self-evident, but worth noting, is that COVID is a macro event, which is to say that it's impacting the bank's entire portfolio, not just a particular loan. It is the proverbial drinking from a fire hose. And a couple observations about that. The bank's bandwidth is limited. And secondly, there may be instances where a particular borrower's asks are informed not only by the bespoke analysis of that particular borrower, but also by more macro considerations. Continued funding. Since the inception of COVID-19, what we have seen at least is that the banks active in lending to mining companies have continued to fund under their existing credit arrangements. And sort of a flip side of that is market participants. In 2008, which in some ways severe disruption, you look for analogies or differences. Now there has been no discernible change in the market participants in the banks lending to the mining space, and where that would really arise is there have been after Q1 a series of amendments or waivers under existing bank arrangements. And that sometimes can be treated as an inflection point when a financial institution wants to exit a sector more generally, and that to date at least has not occurred. COVID-19 related documentation changes. At least from what we're seeing, there has not yet developed any industry consensus on COVID-related documentation changes. There are certainly provisions which are the subject of recurring discussion, material adverse change, and I know this will be the subject of a discussion later on, anti-cash hoarding provisions, and at least some discussion about whether the floors in certain availment options under a credit facility, particularly with respect to LIBOR, given the fluctuations in the bank's cost of funds and how they fund themselves, whether increases in those are warranted. The COVID-19 ARC, for all publicly listed companies, including mining companies, there is a certain consistent periods when they interact and have discussions with their banks. And one of the most prominent or recurring is immediately after, in that period of time after a fiscal quarter end and before the mining company reports on its financial results. So at the beginning of COVID, in the period of time from the end of March until mid-April, it was particularly active. And I think we can anticipate that it may also be active in the period of time from the end of June until mid-August. And the only observation I'd make on that is, to the extent that you're involved with a borrower who may be considering or will be making Q2 asks of its lenders, of its banks, doing so in a timely fashion may make some sense, because you may not be the only person in the queue. A couple observations about how to approach your bank and deal with your banks. The accepted wisdom these days, much like in 2008, is that if you do not have to talk to your banks, then don't. And that may be sound advice, with a couple of exceptions. One, every borrower would be well served to just review their credit agreement and make sure they're aware of their reporting obligations, and ensure that that the team is ensuring strict compliance with that. Site visits. Grant talked to that a little bit earlier, just about how the challenges with site visits is an impediment to new transactions. In many banking relationships with mining companies, there is an annual site visit to one or more of the mining company's mines. To the extent that that's been a recurring dynamic in the relationship between the banks and a borrower would be well served, I think, to thinking about, given COVID may be with us for the near term, about whether there's a virtual analog to providing the banks the equivalent of a site visit. It may ultimately be cheaper, and it also may, just in terms of proactively keeping your banks abreast of your current operations. The last thing on that is just what I would call a COVID-19 update. It seems increasingly common when a mining company is approaching its banks with an ask, or even just regular reporting, that the banks ask for some sort of COVID-19 update. Makes sense? And which is really just some sort of overview as to how the company in question is addressing COVID-19 as it applies to its operations. And I think for the most part, what we've seen is that companies have been reactive in that regard, and I think mining companies would be really well served in being perhaps a little bit more proactive in that regard. And obviously that may just be a matter of course, as now we sort of, as we move, as Grant said, from the triage to the manage spectrum of this. But providing that sort of proactive update on how COVID-19 may be impacting a borrower's operations, I think would serve a mining company extremely well. In terms of prospective, sorry, Sarah, next slide. In terms of prospective bank financings, I think you want to think about two things: sources and uses. So in terms of sources, you recognize that this has been a challenging time for everyone, including banks, and that COVID is likely going to be with us for a few more fiscal quarters to come. In that regard, the banking sector is no different than many other sectors in that in this environment, there's a tremendous power of incumbency. And so I think in terms of, new money, the best source that a mining company is going to have is to look to its existing banks. And in the short term, it may well prove to be the case that even, one's existing banks, it's a challenge to elicit more credit from them. And in this environment, again, Grant referred to the royalty providers and the streamers. It may be that in the present environment that the royalty providers, the streamers, some of the mining funds may prove to be more accessible lines of new credit than the banks, at least in the very short term. In terms of the use of funds, corporate credits probably not particularly relevant in that many mining companies have already established some sort of revolving credit in their favor, which they're perhaps utilizing more so than has been in the past. As far as acquisition financings, again, the power of incumbency will prevail, and one's existing lenders are likely to be, I think, the most likely source of financing for an acquisition financing. The challenge there will be, I think, at least in the current environment, as we straddle, triage and the managed phases, is underwritten credit. It typically in an acquisition financing, an arranged financing as opposed to an underwritten financing is not acceptable, and underwritten financing is required, and that requires on the part of the underwriting institution certain confidence in its understanding of the syndication market, and perfect visibility in that regard may not be what prevails at the present time. In terms of project financing, this goes back again to something Grant was talking about site visits. Project financing typically have a relatively long arc. I think that the likelihood is that COVID is not going to delay and not will only delay to some extent project financings. One of the things that we're seeing in certain project financings that we're involved in the present time is the inability to access the site and do the due diligence and kick the tires is altering the order in which certain work streams of the project financings are being undertaken. Last couple of comments, Sarah, last slide. And I appreciate that my remarks have not really followed the slides particularly well. For that, I apologize. I would just make two comments with respect to one, your existing banking relationships. Notwithstanding the fact that the common coin is if you don't need to talk to your bankers, don't. Then don't. If you don't need to ask something from them, don't. What that doesn't mean is don't pay attention to your banking relationships. To the extent that you can anticipate the ask that you may need to make of your bankers, you can be conscious of the fact that most of the banks are managing a tremendous amount of an uncustomary amount of deal flow at the present time in terms of managing their existing credits. A mining company will be well served. And lastly, just with respect to new financing, I mean, and this goes to again back to what Grant was saying about the state of the market. The banks are in the business of assessing risk. And at the present time, again, as we move to triage to manage and the way forward becomes a little clearer, they will be able to do a little bit better job of assessing risk. And I think once that has come into clearer focus, greater access to credit will be the result. Anyway, Sarah, that's it for me. So back to you.
Thanks, John. That was very interesting. Next, we have Guy Winter to provide a London capital markets update. Guy?
Thank you so much, Sarah. And you can see that I've included there a cheerful headline, open for business. Now, often when a stock market would tell you that it was open for business, you should be extremely worried and infer that it's open for business for nothing but beans and small caliber ammunition. But in the present case, I guess that it's been one of the amazing trends of this particular financial shock, the incredible robustness and the shape of the stock market curve that we've seen. It's something that Grant touched upon in his remarks earlier. But actually, if you look at the FTSE 100 over this period, we've seen an incredibly neat V shape. There seems to be an almost complete refusal by traders in London to look at anything other than the best possible outcome. And so whatever the kind of long-term ramifications are of that, it has meant that the mining companies, the traded mining stocks in London, have really seen a very similar shape. It's a slightly asymmetrical V shape where there's been a very strong recovery to a position just slightly worse than they started off at the beginning of this. And so that has led, obviously, some observers like Citibank most recently to advise everyone that they should raise all of the cash they may possibly need immediately because it can't stay that good. Nonetheless, it clearly creates opportunities for financing. And what we've seen for the mining companies is that in large part, they have been very well served by the equity capital markets. The shareholders, existing shareholders, have been willing to support their investee companies. There's been a ready supply of non-preemptive capital available in secondary placings. There's even been a certain amount of block trade activity. So that's more in the nature of investors reshuffling and recycling capital. But nonetheless, reasonably strong activity. And most companies which have got any kind of robust earnings performance have been supported by the markets through this period. The interesting thing that we come to now, of course, is the availability of new money coming in. And it probably won't surprise you to hear that a lot of the buzz at the moment in terms of the new money tends to be around gold. There's obviously this remarkable at the moment correlation between gold and the equities markets as a result of some of the phenomenon in terms of government stimulus and quantitative easing that has clearly made gold a really attractive asset class. And I was just asking around some of the local brokers who we work with in the sector, and so Novum Securities, for example, said they'd even be looking to raise capital for early stage and development projects where it was in the gold sector. Peel Hunt, on the debt capital markets team, they're very, very interested in any gold stories, looking at raises of over 100 million for kind of straight debt instruments, and then under 100 million for convertible instruments. And so a very, very strong appetite to put money into gold projects at various different stages of development. And I think in terms of the new blood in the market, IPOs are also seen to be making a comeback. We recently saw Trident Resources, a royalties company, raising new money and being admitted to trading on the AIM market. By all accounts, the backlog of IPOs that has built up over the recent period should start to work its way through the system. It's interesting that, to pick up on something that both Grant and John mentioned in the context of site visits. I suppose in the equity capital markets context and the debt markets context, one related element is the roadshow that you'd expect to do to build the book for one of those transactions. And so there have been a few question marks raised over the ability of companies to conduct effective roadshows through Zoom and other kind of video conferencing facilities. Maybe that will act as a slight brake on new IPOs coming through. But what's clear is that it hasn't affected the ability that the banks and brokers have had to build a book where there are existing relationships between investors and the issuers. Another mega trend that we've seen kind of coming through this period is the readiness of the stock exchanges to deregulate where necessary to allow emergency liquidity for companies. So where there's a number of regulatory levers that they can use to make sure that companies have access to funding in the equity capital markets. So for example, preemption rights, so the requirement to issue shares to the existing shareholders first, that's very much a pillar of the UK capital markets, but there's been a significant relaxation to allow larger authorities to allot shares on a non-preemptive basis in the market, from 5 to 20%. We've seen extensions in the periods for filing your accounts as companies wrestle with some of the working capital and going concern issues that the current conditions may have given rise to. We've even seen an acceptance that key modeling COVID-related assumptions can be disclosed in a working capital statement, where that would otherwise be a clean working capital statement. So that's almost akin to the sort of EBIT-DAC concept, which I know that has been coming up in debt financing context. The idea that you can have some consideration in your working capital work as to the impact of COVID and how that might affect the company's working capital performance. Then in terms of the public M&A market, there was a historically low period of activity in the first couple of months of the year. Not surprising, the levels of uncertainty that we've seen. But what we've noticed from speaking to bankers recently is they're certainly talking up consolidation in the gold sector. We already touched on the sort of fairly unique macroeconomic conditions that are driving gold so hard at the moment. It's probably fair also to say that the London market had lagged behind Toronto in terms of consolidation in the sector. There are a lot of smaller players who are really looking to consolidation to build scale. Organic growth and very significant new investment plans may be more challenging. So there are a lot of drivers there to some more consolidation in that sector. Again, one of the inhibitors that's being perceived is site visits. However you might feel about doing a general update through a video conference, you're obviously going to want to get out onto the asset in a M&A context. And so, again, it will be interesting to see the kind of workarounds that people are able to come up with using some of the existing data which is out there to allow them to get comfortable enough to push on with consolidation in those circumstances. And then the fourth mega trend that I wanted to touch upon just in this discussion is really around climate-related disclosures. We already had a proposal in our listing rules that there would be a requirement to disclose against the Financial Stability Board's Task Force on Climate-Related Financial Disclosures guidelines. And we expected that would be introduced into the listing rules in October. Whether or not it goes to schedule with that, I think it's plain to see that with the wider context of ESG and the concept in many of the government stimuli of a green-led recovery, that's going to be a bigger issue than ever for listed companies on the London markets and beyond. But one would hope that would also give rise to some interesting new funding opportunities. So there's a huge amount of stimulus which is being made available within the European Union, for example, where they have a 750 billion euro plan, the Next Generation EU plan, which is really based around environmental drivers. And so you'd expect that that will have a knock-on in the way that capital is deployed generally within Europe. So hopefully the push to ESG in terms of reporting and compliance will also unlock some of the funding opportunities that may exist in a green-led recovery. Thank you.
Thank you, Guy. Much appreciated. Great to hear some positive news as well. We will move on to the next panel where my colleagues Gesta, Abols, and Darren Reed will discuss material adverse change clauses and considerations arriving out of the pandemic.
Great. Thanks, Sarah. It's Gesta Abols speaking. I'm an M&A partner at Fasken based in Toronto. I'll start and then hand it over to my colleague Darren. Next slide, please. So if you're not familiar with the jargon, MACs or material adverse change clauses appear in virtually every M&A agreement. And what they do, it's sort of like a nuclear weapon. They blow up a deal. So a buyer has a right to walk away if a MAC has occurred. And they can walk away without paying any sort of fee, and the deal just dies. So the consequences for a transaction are profound. And in light of the uncertainty and economic carnage that COVID has wrought, people have looked for announced deals, you know, the clauses, and questioned whether or not one can allege a MAC. Next slide, please. So Darren will get into some of the legal niceties and the status of the case law, and there's some interesting developments there. But I thought it would be helpful to give a bit of context to understand how the clauses actually work. Because if one were to pause and ask a person on the street, you know, do you think COVID's a MAC? I would suggest virtually everyone would say, well, duh, yeah. I mean, the world shut down. You can't go to your office. Nothing's operating in the mining space, and in certain areas that the mines have had to be shut down. Of course, it's a MAC. What we're here to tell you is not so fast. That's not exact. The MAC clauses are more nuanced than that, and really at their core, what they're about is sort of risk allocation, and the buyer generally you know, has to, you know, can walk if there's a specific issue to the business, but industry-wide and sort of exogenous risks are normally excluded. So there's a bit of jargon there. So if I can simplify it a little bit, and I'm going to warn you in advance, there's double negatives involved here that it can sort of tie you up. So just starting with the beginning, the clauses, the heart of the action shows up in the definition. So the agreement will have a one-liner. It's a condition, says there's no max. So that's easy. We can all understand that. The definition is where the action is, and the definition can take almost an entire page. And the first part says what a MAC is. And on the slide, you'll see a couple lines there, but it can go on. And it really, what we're talking about is a material adverse change to the business taken as a whole. It can deal with forward-looking matters, and that's relevant to COVID. So something that would reasonably be expected to have, and in limited circumstances, the definition will speak of the prospects of a business. So first of all, it says what a MAC kind of is, but then is a number of exclusions, things that aren't a MAC. You could, for example, list COVID-19 is not a MAC. Some agreements that have been signed up have excluded that. Others have mentioned pandemics more generally. Most agreements will list things like terrorism or general economic conditions. So if you're trying to determine if COVID would be a MAC on a deal, let's say you get past the first bar and Darren will speak to the case law, that you have a material change. It's not crystal clear that you would, but let's say you get past that. Then you look to the exclusions. Is this something of a general economic nature? Do they have a specific thing on pandemics? Do they have a specific carve out for COVID-19? And then I alluded to a double negative. There's usually, not always, but usually another clause that looks back and say, well, all these things that we're excluding, because they're general in nature, sort of exogenous to the business, if they particularly impact the company, then we're going to bring it back in and say that's a MAC. And to try to make that real, the example I've used in the past is a natural disaster. Typically, a natural disaster is excluded from a MAC. But if your business has, let's say, one mine that happens to be beside a large body of water and a tsunami hits and floods the mine and destroys it, that's probably going to be a MAC in that circumstance because that company has been disproportionately impacted. So that's sort of the basic structure of MACs and how they work. And so with that, we can go to the next slide. Yeah, and I'll turn it over to Darren now.
Thanks, Gesta. Interestingly, what we have in Canada is a lack of law on MACs. The cases that have come before the courts in Canada, where the courts are asked to interpret material adverse change or material adverse event clauses, largely are decided on the canons of contractual interpretation that already exist to common law. So there's not a lot of guidance in Canadian case law about MACs specifically. What we do have, and what the slide notes, is that most Canadian M&A practitioners look to jurisprudence from the US and in some smaller part to the UK, because what we have out of the US is a fairly established line of cases that set out a couple of basic interpretive principles that the courts in the US, or at least in Delaware and certainly in New York, will follow when they're faced with MAC cases. So what does that mean? If you look at the Canadian decisions that exist, they spend a lot of time, as the US courts do, interpreting the contract itself, winding their way through complicated clauses, trying to figure out whether a MAC has occurred, whether there are exclusions, and whether there are exceptions to the exclusions that reallocate the risk. What we do have in Delaware is a line of cases that map out that a MAC requires, first of all, materiality, and there's some fleshing out of what materiality is in what I would call, and what the case law generally calls, a general MAC, and also that it must be durationally significant. And what that is, and this is the last bullet on this current slide, is there has to be much more than a short-term drop in financing, and there has to be a fundamental change in the business. So this requires a qualitative and quantitative analysis. And as a litigator, when I read some of these cases, one of the issues that arises is actually having to prove this in a very tight time frame, and usually before you have significant evidence of a long-term drop. You need expert evidence to kind of project things, and I'll mention this in just a moment. Next slide, please. So some recent decisions out of Delaware have found that material where it's not fully defined by the agreement means that which would substantially threaten the overall earnings potential of the target in a durationally significant manner. And I've just cited a recent case there. The interesting part about that is, how do you prove this? Another case that was recently decided out of Delaware, the Acorn case, went from sort of the initial pleadings to a week-long trial in the course of 11 weeks. There was over 50 depositions taken, just under 2,000 trial exhibits, and not quite 10, I think there was 7 or 8 expert witnesses that gave evidence before the court. And you can imagine trying to prove on the part of the prospective purchaser who has issued the MAC notice that there was a material change, but also that it was durationally significant when it happens and then you're in trial 11 weeks later. So there was a lot of expert evidence, and that's what these cases actually require in order to meet the test. What we have in Canada, and this is something that our firm and Gesta knows a lot about this, is, as we've been following closely, is a case out of Alberta, which is a MAC case, and it is currently before the Alberta courts. So it's the Rifco and CanCap case. Rifco is an automotive financer, and in essence, the deal was structured as a statutory plan of arrangement. And for those of you who aren't familiar, there's a two-stage process that's followed in our courts, where there is a preliminary order issued by the court, notice is given to shareholders, there is a chance to object, and then there is a final order issued approving the proposed plan of arrangement. This deal was to go by way of a share purchase, and the first order was issued. The hearing for the final order was scheduled, and then the COVID-19 pandemic broke out and the collapse of global oil prices that affected Alberta occurred. So a notice was issued just about a week before the final hearing was scheduled. The prospective seller, Rifco, tried to force the purchaser's hand by having a hearing where it said the deal ought to be approved by the court, notwithstanding the issuance of a material adverse change notice. The court, in essence, declined to have that happen and has moved it on to a further hearing. So what we are expecting to see is a fulsome evidentiary base established, and the court deciding, arguably for the first time in Canada, whether or not some of the U.S. law ought to be imported into Canadian jurisprudence, because that is, in essence, what the parties have been arguing. So as that case unfolds, it will be interesting to see what, if any, of the U.S. case law is imported into our jurisprudence and how that withstands potential appellate scrutiny. The justice is hearing the matter, and I believe is seized with it, practice as a commercial solicitor and barrister her whole life. And so we'll see whether she decides to import that or not. Next slide, and back to Justin.
Thanks, Darren. One thing, I'll get into the analysis, but one thing worth mentioning, and you know, there's a lot of ambiguity, obviously, in the case we talked about that's before the courts, and what is or isn't a MAC, and some of that's deliberate. And the reason for that is, well, first of all, as I described it as a nuclear weapon, and you don't want those to go off by accident. So rather than, for example, just putting in a bright line test that says a MAC is earnings down by pick a number, people could sort of keep it deliberately vague. And the idea is typically people will come back to the table where things have gone south and either you know, recut the deal. That could be a change in price, or agree to walk away, maybe there's a fee paid, or just threats of this big litigation where one party says I'm walking away and the other says we're going to sue you for the deal price, and you come up with a compromise. But you don't want a tripwire for a weapon of that nature. And the other thing is the courts don't want to find MACs for the same reason. And they don't want to be a party to buyer's remorse. So Darren mentioned a Delaware case, Acorn. So notwithstanding the lack of litigation here in Canada or case law, there's been a lot in the US, but Acorn was the first instance where the Delaware court actually found a MAC to have existed and allowed the parties to walk away. And so on this slide, you'll see buried in it sort of what is material. In that Acorn case, notwithstanding some really bad behavior on the part of the target regarding sort of government FDA type stuff, their EBITDA dropped 86%. And analyst targets slashed, you know, the value of the company from 32 to, in some cases, $5. The former Chief Justice, his name's Leo Strine, on a different case was torn as to whether a 64% drop in earnings constituted a MAC. So you can see it's a pretty high bar, and on that point of what's durationally significant, it's generally viewed that it's measured in years, not months. Now, that being said, we are in this time of crisis and things are really bad and some businesses are totally locked down and dropping. And so, you know, if COVID constitutes a MAC in this context, really has to be examined on the facts. And you need all that evidence that Darren was alluding to that they're asking for in the RIFCO case to really unpackage what's going on and whether or not it would be a MAC. Now, some of you might be sitting back and saying, well, this is all ridiculous. What does this mean if I'm trying to do deals? There are other levers if one was trying to exit a deal for legitimate reasons. One's just saying, this is not at all what I thought I was signing up for. I mean, I was willing to pay X for the company as it was on January, but it's a totally different beast. There are other areas in an agreement to look to, and one of the most obvious would be the covenants that a business must continue in the ordinary course between signing and closing, and sort of things that the target must do and things that it can't do, and how does COVID impact that? That may be a more fruitful path for examination than the actual MAC clause, largely because it may be carved out and we don't really know the impact at this point in time. So with that, unless some questions come in that we can address later on, I don't have anything more to say on MACs and COVID. So thank you.
Thanks, Gesta. Thanks, Darren. Now we're going to move on to our panel with my partners and friends, Tóth and Brad Freelan out of our Toronto office, and a discussion of recent RTO and M&A activity.
Thank you, Sarah. So I'll present first and my partner Brad will present second. So what we've been seeing lately is our clients are looking to basically exploit what I call the golden rule, which is he or she who has the gold rules. And so the RTO method it's too cumbersome, it takes too long. And so a lot of companies are looking to do something similar to joint ventures, earn-ins, or expedited acquisitions if you're under the TSXV rules. And the reason they're doing this is because there's a lot of assets in other companies where they're not getting credit for them as part of their resource base because it's actually a liability to develop given they have other projects. And so in order to advance these projects and get funding for exploration, they're moving them into basically shell companies and doing it by way of an earn-in agreement with other folks who can finance off it because that asset gets more attention and focus. So the advantage of this method is you don't spend 5 months trying to get an asset out to RTO it or otherwise develop it. You can finance that right away and close it in a really, really short amount of time. And then you're here to be able to take advantage of the existing market conditions. And we've got a few of those both in gold, PGM, and some other sort of base metals. We've seen them as well too. And so that's the way I think the market's going to go lately, is people know that the markets are running and you can't wait around for the regulatory approvals for a full-blown deal. So you try to find one that's the best way to finance and get your asset some credit. And this is good for the majors because until the junior company earns into that asset, they get to keep those resources and reserves on their books. And ultimately, this resource or reserve, which could be fifth in their list of projects, gets moved up and advanced with no cost to the major and without them sort of having to take a penalty for having a languishing asset on their books, both in respect of their shareholders and also the communities in which they operate in, which also want to see these assets developed as part of their recovery from COVID and seeing investment made into the local sector. So sometimes in times like these, you got to rethink the alternative way and figure sometimes you got to leave a little bit on the table in order to kind of get your asset developed in a quicker manner. So I guess that's what we're seeing right now is the RTO might be kind of pushed to the back burner for a while the joint venture earn-ins and expedited acquisition transactions come into play in order to take advantage of markets and also relations with the communities you operate in to see that their assets are being developed and jobs created. So I guess that's sort of my spiel, and I'll turn it over to my partner, Brad.
Thanks, Krisztián. So I'm going to talk a bit about recent M&A activity in the gold sector. Before we get into that, though, let's just rewind to 2018 briefly, just to set the stage. So, as you may recall, in January 2018, the price of gold was about $1,400. but had dropped to about $1,200 by September, and market sentiment, I would say, was fairly negative. It was around that time, though, that Barrick and Randgold surprised the market by announcing a very large no premium merger. Now, that deal received positive reaction from shareholders by both companies, and at the time there was speculation that the transaction might trigger more deal making in the then struggling Canadian gold sector. Now, to some extent, this proved to be true, and there were a number of high-profile deals in 2019. Starting with in January 2019, Newmont announced that it was acquiring Goldcorp for $10 billion with a 17% premium. Following that, in May of 2019, St. Barbara announced the acquisition of Atlantic Gold for $550 million US at a higher premium, 39% premium. There was a flurry of activity in the M&A space in the fall and winter of 2019, starting with Kirkland's acquisition of Detour for $4.9 billion. That was a 29% premium. Then Zijin Mining announced the acquisition of Continental Gold for $1.4 billion, again a 29% premium. And then finally, at the end of the year, Equinox announced a merger with Leagold. That was also a no premium deal. So now, with that context, let's look at 2020 market dynamics. And as some of the panelists have touched on already, the price of gold has been increasing sharply in 2020 in response to market uncertainty and the quantitative easing announced by governments around the world. There does, however, remain speculation that, in light of the large write-downs that mining companies took the last time we were at the peak of the gold market, that there would continue to be transactions being done at low or even no premiums, and that those would be continue to be the new norm. So let's look at what's happened in 2020 to date. So in March of 2020, Endeavour Mining announced the acquisition of Semifo for $1 billion. That was done at a 27% premium. SSR and Alistair Gold announced a merger. It was a $1.7 billion acquisition of Alistair. No premium for that deal as well. And then recently, Shandong announced the acquisition of TMAC, smaller deal, $230 million, and at a larger premium, 52%, based on the 20-day VWAP, only 20% based on spot. But there's one transaction I want to highlight in particular, and that's the Guyana Goldfields transaction that we have been a part of. We've been acting for Guyana. So on April 27th, Guyana announced a deal with Silvercorp, valuing Guyana at approximately $105 million. That was a 71% premium based on the 20-day VWAP. Then on May 11th, Gran Colombia announced that it had entered into a definitive agreement with Goldex and proposed a merger with Guyana at a 50% premium to the Silvercorp offer price, which would have valued Guyana at about $158 million. On May 13th, Guyana publicly rejected the Gran Colombia offer, based in part on the increased deal risk associated with the cross-conditionality of those transactions. And then on May 17th, Guyana announced that it had agreed to amended terms with Silvercorp that valued Guyana at approximately $227 million. And in that press release, Guyana disclosed that the terms were amended following an unsolicited all-cash proposal from a third party. Then that deal didn't stop, though. Then on June 3rd, Guyana announced the receipt of a superior proposal from a third party at a 35% premium to the amended Silvercorp offer, which would value Guyana at over $305 million. So for those of you keeping score at home, the most recent offer price would represent a 430% premium to Guyana's unaffected 20-day VWAP. Now, obviously, it's not clear if this transaction is an exception to the new norm, but it sure makes for an interesting data point. So thank you. That's all I have on an M&A update, and I think I'll hand it back to Sarah.
Thanks, Brad. Thanks, Krisztián. We're now going to move to our question and answer session. If you have any questions, please submit them through the Q&A chat box located under the video right at the bottom of the screen. We do have some questions that have come in. Our first question will be directed to Grant. Grant, you were talking about different deal structures and considerations that you were looking, that the PE firms were considering. Do you have any specific ones that you're expecting to see in the resource space by PE firms?
Yeah, thanks, Sarah. I think that we will see, there's been a couple pipe deals happen. I think that private equity will access or try to access, it really depends on the stock market. If the stock market just keeps on going up and up and up, we might not see anything, and resource companies just stick to traditional equity. But if there is a gap in financing, and if, as John had said, that traditional credit facilities are not there to get to, or project financing is delayed, I would see private equity firms possibly accessing pipe transactions in kind of the second half of this year. Not in precious metals, as Krisztián had said, precious metals are on, and Brad had said that they're on fire right now. But on the other base metals and other metals, I think we'll see some pipe deals happen in the fall.
And to follow up on that, Grant, do you have any other industries that you expect to see activity in the near future, other than the ones you've already mentioned?
Yeah, well, in the private equity sphere, resources, in the oil and gas, I mean, we're not talking oil and gas here. I think there's going to be some. I think there's going to be some private equity movement in oil and gas. The pricing's right, and oil and gas is not going away. And I really do think the private equity and the base metals will happen. The economy is taking a hit here for the next 6 to 18 months, but I have a feeling that investors are looking at this as an unbelievable time for value, and able to get in on those metals during this time. And and some of those specialty metals also that we may see activity, they've been a little bit hit in the last few months, pricing, that people may pile into those also.
Thanks, Grant. Guy, we have a question following up on the presentation on material adverse change clauses. Have you seen any material adverse change clause issues arising from COVID-19 in the London markets?
Yes, and first of all, I was most offended that you always look to Delaware and not to the UK for the jurisprudence on this. That's we'd like to see some of the old ties remembered a bit better than that. But yeah, I think there is actually a good reason though, which is that in the UK, public M&A is actually regulated by the Takeover Code. And so whilst it is very, very common, probably invariable, that in your takeover offer, you're going to include a MAC condition to the offer, the application of that is then regulated by the takeover panel. We actually have had quite an egregious case which has been going through the various appeal processes at the takeover panel recently. There's a company called Moss Bros, and what their main business is like rental formal clothing. So if you're going to Royal Ascot and you need a top hat, and your old one isn't up to scratch, you go and rent one from Moss Bros. You can imagine that business is very badly affected by, I guess, COVID. Ascot is off, and so someone had put in an offer to acquire Moss Bros, but they did it on the 12th of March, and then on the 22nd of April, they invoked the MAC clause to say, well, actually, it turns out that the restrictions that have been imposed mean that this business is worth a lot less than we thought it was. And this has received absolutely no sympathy at all from the takeover panel or in the city. And what's quite interesting, because it is a relatively egregious case, it's really been focused that this it has to be a matter of very considerable significance, striking to the heart of the purpose of the transaction. And so in this case, they actually took into account the fact that the circumstances should have been reasonably clear that it was possible that this change might take effect. So even though the condition actually related to government action, the fact that the circumstances were not completely unforeseeable, I think, have been taken into consideration. And in any case, we already had a very clear position that it doesn't have to be full contractual frustration, but it must strike to the very heart of the purpose for which the deal was done.
Thanks, Guy. I guess to follow up on this, obviously we've got a couple of cases that are before the courts or the various panels. Do you expect to see more parties exercising MAC clauses coming out of this period? Guy or Gesta?
Sure, I can speak to that. I mean, I think yes, you will. Whether they'll be successful or not remains to be seen. But I think, you know, I really take some market observations. You're seeing some additional U.S. cases, and there's the luxury, the French-based luxury goods producer who is buying Tiffany. Apparently, they're looking to exit their deal. I mean, I think for all of us, while I too have the sympathy of the takeover panel and take the view that, you know, much of this was reasonably foreseeable at the time of entering into agreements that are live. You know, we don't know the full scale of things, and I think it is going on a bit longer than maybe deal makers thought originally, and the impact is reaching deeper. So whether that'll persuade a court or a takeover panel, I think it's still a tough argument to make, but I don't think that'll stop people from making it. And sort of what I alluded to in my earlier comments is parties may end up just going back to the table and recutting deals or finding graceful exits. I mean, we are in unprecedented times, and so much of my chat from the strict lawyer's perspective finds, you know, there's a lot of hurdles. But when you get back to my initial observation to the person on the street and you ask them, is COVID a MAC or not? And they just answered, duh, that there's some truth there. And so I think you will see more people threaten to exit deals, and whether they actually go to litigation or recut the deal or pay to walk away, I think we will see more of that.
Thanks, Gesta. I should mention that we are following material adverse change clauses and the impact of the COVID market quite closely, and we've been blogging about it. So if you're not signed up for our timely disclosure blog, which generally deals with securities and M&A matters, feel free to do that, or email us and let us know if you'd like to be added for that. We've been following the Canadian case in particular very, very closely. John, Torrey, I have a question for you from one of our audience members regarding bank lending. How much resistance from banks have you seen to their borrowers drawing down on credit facilities for the purpose of cash hoarding? The comment was, many mining companies seem to have done this.
It's a great question. It is certainly the subject of a significant amount of discussion. I am going to answer your question, Sarah. Back in 2008, there was, you know, there was after the fact impetus to try to put in some cash hoarding provisions. At present, it is the exception rather than the rule. There are not that many credit agreements that do have cash hoarding provisions. And so, absent a specific cash hoarding provision, assuming a credit is otherwise in covenant compliance, and which is typically the case because most financial covenants in a credit agreement are done on a trailing 4 fiscal quarter basis, and so it takes some time to work through deterioration in one's operations through the financial covenants. Where the lenders were really focused on was with respect to, you know, MAC provisions. And generally speaking, lenders are hesitant to rely on a MAC where a borrower is otherwise in full covenant compliance under its credit. Where lenders are having a dialogue with their borrowers about cash hoarding provisions is in connection when a borrower is coming in for some sort of covenant relief or other amendments to their credit. And obviously, when a lender, when those discussions happen, the lenders can condition those amendments, as they see fit and as is mutually agreed upon. And so there's some discussion there. I would say that they are not going in as a matter of course, that there are some instances where they are being added, and that that those anti-cash hoarding provisions, there is a spectrum, and the spectrum really is on one end just a statement of principle, thou shalt not cash hoard, and on the other end of the spectrum is something which is more of a bright line test that you won't draw down more than a certain period of time of your prospective working capital requirements. I think this does have to be seen in the context of, as I noted earlier, is that generally speaking, lenders to the mining space, have been honoring their their obligation to fund through the triage phase of COVID. Anyway, over to you, Sarah.
Thanks, John. And I guess there's a follow-up question for you as well. Do you anticipate that an industry consensus will emerge on certain COVID-related documentation changes?
My own sense is not, and the reason is because I think that the members of the mining borrowers occupy a wide universe, whether it's base or precious metals, composition of their number of producing mines, the location of those mines. So each company is somewhat different, and I think that we will be out of this, and COVID will be in the rearview mirror, not shortly, but so I don't think this is going to have the duration where a consensus will obtain. So I think the short answer is no.
That makes sense. We're still getting some more questions, so again, feel free to add your questions to the Q&A list that we're getting. This one I'm going to open up to the whole panel. This is a question from Benjamin Perez, who is a partner at Guerra Olivos in Chile. And the question was, is there any interest in offtakes or acquiring royalties in Chile? Not sure if Guy or Krisztián can speak to that. That might be a bit of a specific question that we might need to look into.
I think maybe the next session's the best to answer that when Brian's on the line. But generally, I can't comment on Chile itself, but we have seen a lot of royalty and other type of financings also heating up as another method to finance. As for jurisdictional, I think tune in for the next presentation when our streaming expert's going to be on the line.
And Gesta, we've got another question for you on that closet. What happens if the Canadian courts don't follow the Delaware cases? What impact do you think that would have? Maybe they'll go to the UK, but what's your opinion on that?
Well, I think the principles, it sounds, Guy, are similar, is that neither the takeover panel nor the Delaware courts want to sort of empower buyer's remorse, and so that the hurdle remains high. There's a risk that bad facts can make for bad law. And we could get a decision, in these extreme times that create a lot of uncertainty into the meaning of these clauses. But I think the risk of that is small. I did sit through the initial sort of hearing on the case in Alberta, and the judge seemed conscious of the broader impact that the case could have on the markets. And in fact, the only decision that she's made right now is that she wants the evidence that Darren in his presentation alluded to, that you can't rush to judgment here. If we change dramatically, I think we'll just have to pivot, and Canadian M&A lawyers will have to sort of read it and figure out what is there a different principle here, and either adjust our drafting to be to have the agreements work the way we want. But I think the reasons out of Delaware, whether they explicitly adopt all of them, will have a great influence. They're pretty thoughtful decisions and particularly well written. So I guess we'll wait and see.
Thanks, Gesta. John, Torrey, one last question. When do you anticipate a more robust market for bank financings?
So it's a good question. I think the answer is, in terms of bank financing generally, the answer is probably obviously sectorally based. So I think insofar as mine bank financing is concerned, you sort of want to work backwards. The banks are going to continue to be in the business of lending money. There are certain sectors which are going to recover more slowly: aviation, hotels, retail, perhaps oil and gas. And I think when you put it in that context, you have the banks that lend on a recurring basis to the mining sector are highly expertised, and my own sense is to the mining sector it will be in the next fiscal quarter or two. So sooner rather than later is what I would say.
That sounds great. Thanks very much, John. Are there any other questions from our attendees? Okay, we'll sign off now. Just a reminder that we would appreciate it if you would complete the feedback survey at the bottom of the screen where the Q&A chat box is. There's also a survey button where you can click. And if you're interested in signing up for the next 3 seminars, please feel free to do so. We hope that you've enjoyed this webinar, and thank you for joining us, and please take care.